If you're not an all-cash buyer, then when you purchase a piece of income-producing real estate, you'll probably need to secure mortgage financing to complete the deal. It can be helpful, and I really should say essential, for you to understand what your lender is looking at when underwriting that loan. And if you guess that he or she is not admiring your millinery, okay, then you qualify to stick with me here. I'm going to discuss quickly a couple of key yardsticks. Maybe the most basic underwriting guideline for any type of property is the loan-to-value ratio. This is the relationship between the amount of the loan, all loans actually if more than one is involved, and the value of the property. The formula is just simple division, as shown here. Value has a particular meaning here in the language of mortgagees. It's the lesser of the selling price or the appraised value. So, let's say if your cousin the appraiser brings in a fantastically high value, higher than the purchase price, you might be hoping the lender will offer you a loan based on that higher amount. You can argue that you're a world-class negotiator, that you're buying the property below value, yada yada yada, but you're going nowhere with that argument. Now, the lender is going to base the mortgage amount on the lesser value, in this case, the contracted purchase price. Let's look at a quick example to put some numbers on this. You go to a lender whose maximum loan-to-value for underwriting purposes is 70%. You contract to buy a particular property for $1 million. The appraisal comes in at $1.2 million. You're happy and you're hoping to get 70% of that 1.2. That's $840,000. But the lender says, no, you're getting no more than 70% of the contract price, the lesser amount, and that's $700K. On the other hand, if you're the world's worst negotiator, and the appraisal indicated that the property is actually worth less than you agreed to pay for it, well, no joy here, you're still going to get the short end of the stick. The lender again is going to look at just the lesser amount, and base the mortgage this time on the appraised value. So let's say you contract to purchase a different property, also for $1 million. But alas, this appraisal comes in at $900K. So you would like to get 70% of the $1 million purchase price. But again, the lender says no. We'll give you 70% of the appraised value. 70% of $900K or $630,000. They're not being arbitrary. The lender wants to be certain that you have enough of your own money committed to this deal. The more cash you invest, the less likely you are to bail out if you have a bad day or a bad year. And of course, the bank or mortgage company wants to maximize its chance of recovering the full indebtedness if it has to take back the property and sell it. Okay, there's another metric that's important to securing a commercial loan, and it's often overlooked by inexperienced investors. It's called the debt coverage ratio, DCR, or sometimes debt service coverage ratio, DSCR. And you can be confident that the lender will be looking at it. This measure expresses the relationship between how much money you have available after paying your operating expenses compared to how much you need to make the mortgage payments. More specifically, or mathematically, it's the ratio between your annual net operating income and your annual debt service. Just a side note, if you've forgotten what net operating income is all about, I have a 2-part video blog post about that. But in short, your scheduled, aka potential gross income, minus vacancy and credit allowance, minus operating expenses, is your NOI. Okay, let's get back on track here. So here's the simple formula for DCR, debt coverage ratio. If you have exactly the amount of net income needed to meet the mortgage payments, then these two amounts are equal, and the ratio between them is 1. Be assured that the lender will not be happy if this is the case. It means the property is producing just enough cash to pay the mortgage and not a penny more. No room for surprises, no wiggle room, not good enough. Each lender sets its own DCR requirement, of course, and you need to find out what's required by the lender you're planning to deal with. Traditionally, a common standard was a DCR of at least 1.20, but since the Great Recession of 2008, it looks like that standard has crept up to 1.25 generally. But don't take that as gospel by any means. It could be higher in certain markets or for certain property types. The only way to know for sure what you need to achieve is to ask your lender what their requirement is for underwriting. Let's say you have a property with $100K gross scheduled income, 3% vacancy and credit loss allowance, $37,000 in operating expenses, and $48,000 in annual debt service. As you can see here, that means an NOI of $60,000. Divide that by your $48K in debt service, and you have a debt coverage ratio of 1.25. Finally, it's important to be mindful of these objective measures, but there's also a subjective consideration that you really need to take into account as well. And that's the presentation you make to the lender. If you want to be treated as a professional, you need to make a professional presentation. You should not assume that the property's numbers will speak for themselves, or that the lender even has all of the necessary and correct information. Don't just do your homework. It's not enough simply to figure out for your own benefit what the debt coverage ratio or NOI or cash flow will be for this year or for the next 20 years. When you make your bid to obtain financing, you want to show the lender that the numbers work and that you understand how they work. Make a good and thorough presentation of these facts. You're accomplishing two important goals when you do that. You're taking the initiative with the presentation of facts, assuring yourself that the lender is at least starting off looking at the same numbers you are. And you're also demonstrating that you're not a back-of-the-envelope scratcher, but rather a serious and knowledgeable investor. I mean, if you were lending your own money to a third party, wouldn't you feel more inclined to do the deal with someone who exhibited some financial acumen and made a professional presentation? Now, at this point, I could make a self-serving pitch for RealData's software and educational materials to help you with all of this, but I'll let you discover those when you're ready. For now, your marching orders are these. Start by finding out not only the lender's loan terms, but also their underwriting requirements, loan-to-value, and DCR for the type of property you want to finance. Then, make your financial projections. Determine your NOI, forecast your cash flow. See if you can meet the DCR with the loan amount you're seeking. If the numbers don't work, reevaluate the deal before you go to the lender. Maybe you'll need to invest more of your own cash to reduce the debt service. If and when the numbers do make sense, then build and deliver a professional presentation. Get the loan. Make the deal. That's what investing is all about.